Welcome to Private Equity Profits. Clifford Locks is a certified board of director, a trusted confidant to CEOs, C-level exec, and high-potential employees to help them clarify goals, unlock their potential, and create actionable strategic plans. Seth Greene is the nation's foremost authority on growing your portfolio companies with direct response marketing. He is the founder of the direct response marketing firm Market Domination LLC, and he is an 8-time best-selling author who has been interviewed on NBC, CBS, Forbes Inc., CBS Money Watch, and many more. Cliff and Seth interview top players in the financial sector, focusing on private equity firms, venture capital companies, and family offices, discussing developments and trends shaping the industry. These experts will share with you how they've grown their businesses and increased profit, and how you can too. And now, here's your host, Cliff Locks.
Welcome, everybody, to another episode of the Private Equities Profits podcast. I'm Cliff Locks, your host. And today our guest is Jordan Tate, a partner at Montage Partners, a private equity firm located in Scottsdale, Arizona, and founded in 2004 and manages over $70 million of capital. Montage invests in established, successful companies with $1 to $5 million of EBITDA in the business services, consumer, industrials, and technology industries. In his role at Montage, Jordan serves as a member of the board of directors for 6 of the 9 companies which Montage is currently invested. Prior to Montage, Jordan was a member of the investment banking group at Merrill Lynch Co and worked on mergers and acquisitions and corporate finance transactions across a variety of industries. Jordan holds an MBA with honors from Wharton School at the University of Pennsylvania, bachelor's degree in finance and accounting from the University of Arizona, and Jordan is an active member of the Arizona chapter of the Young Presidents Organization, YPO, and built a great life with his wife and 3 boys. Jordan, thanks so much for being here today. I'm excited to have you on.
Thanks, Cliff. Appreciate you having me.
Same. Tell me about your background and how you got started and what led you to private equity.
Sure. So you covered the basic background on the firm, so I'll skip over that. But for me personally, I'm 41 years old. I started my career in investment banking roughly 20 years ago. Mm-hmm. In 2004, I moved home to Arizona, co-founded Montage Partners, and have spent the vast majority of my career here. And we've been fortunate to have partnered with a lot of great people on the management teams that we work with and within our LP group. Had a lot of luck so far, having invested now in 18 companies. We've successfully exited our investments in 8 of those. We have 10 active investments, one of which is relatively new within the last 30 days. So it didn't make the list, I think, from the bio that you just read. Mm-hmm. But we, in spite of our 17-year track record that we're proud of, we still think about ourselves as being in the early innings of building what we see as the leading lower middle market private equity firm, which is still a very fragmented corner of the market. And along the way, we're having a lot of fun.
Really important. And congratulations on that exit. You're doing some great things for your investors and for your team. So. You founded Montage Partners. What makes you different than other private equity firms? And tell me about the culture of your firm and what separates you from others.
Yeah, so good question. As you know, there are well over 3,000 private equity firms in the US. And if you include sort of the periphery there of the so-called independent sponsors and search funds and other folks that are competing in the same space, it's probably much larger than that. Not every firm's the same. And so things that we value are working with people that we like and trust, helping people achieve their objectives. So that's one of our 6 core values is people. And we mean a lot of things by that. We mean we're primarily focused on people we're partnering with at the companies that we're investing in, the people who join our team. We value people. We realize it's people that are driving the success of those companies that we're putting capital behind. And ultimately, it's people that make our job fun. So we're not fun if we make a mistake. And I think the same thing applies if you're sitting in a founder's seat thinking about exit options and you're exploring different private equity firms. I think it's important to keep in mind that not every firm's the same, and every firm is essentially made up of a bunch of individual people and the culture of that firm. So spend the time to get to know those people, and you'll learn a lot about that. In addition to focusing on people, I'd say transparency is a core value for us that's very different than some other firms. And even during the transaction process, we're focused on no surprises. So that could be good news. It could be bad news. We're not the guys that are going to sort of focus on holding our cards close to the vest, posturing so that we can win one over on somebody. We don't like to waste our time. We don't like to waste anyone's time. And so we'd rather just tell folks what works for us, what doesn't work, find out if there's alignment. If there's not alignment, wish them the best. And if there is alignment, everybody can move forward knowing that all the cards are on the table. Everyone's being super transparent about what their objectives are. And there's a true win-win relationship ahead.
I think this is a breath of fresh air. I mean, that openness on the front end. You interviewed an individual that was talking about the premortem versus the postmortem. So you're actually setting those KPIs on the front end and what you're looking to achieve, and you're being open with the company that you're looking at this point in the due diligence process. And I think that that's extremely important. After you close, you get that integration piece, and to keep people motivated and up to date on what you're working on, what your long-term plans are. I think that's a very important way to address the market. I want to salute you for that.
Yeah, appreciate it. And totally agree with the importance there. It's probably the most important part of our diligence process is working with, whether it's a founder or the leadership team that we're going to partner with, to set objectives so that everybody's accomplishing what they want to accomplish. Timelines are established. We've got a realistic set of projections that we're working towards and strategic priorities that everybody's aligned on. I think the scariest thing for us and also for a founder or a management team that's taken on a private equity partner is going into a closing so focused on the deal mechanics that you get to closing, you execute a purchase agreement, you wire funds, and then you think you're going to, in the first 100 days or first 6 months post-close, then map out what those strategic priorities are. That's a scenario where it's more likely to open up differences of opinion versus doing that during the diligence process.
Wisdom. Thank you for sharing that. Tell me about the companies that you're investing in.
Yeah, so there are 4 sectors that we focus on. That's business services, consumer, industrials, and technology. Fairly diverse in terms of sector. We're focused on those 4 verticals, so it gives us an opportunity to at least define our market. So you mentioned 1 to 5 million of EBITDA earlier. We're investing across North America, so geographically, US and Canada, and those 4 sectors. Beyond that, when you dig a layer deeper, we're focused on things like revenue retention, consistency of margin profile, consistency of performance through different economic cycles. And then we're focused on people and culture, which is more difficult on our side to be efficient with time and assessing. And we'll see on the order of 1,300 companies in any 12-month period. We're not spending a lot of time on the vast majority of those. But at any given time, we're in discussions with and doing a deep dive on 20 to 25 of those companies. And that's where we really get to know people. We get to understand what everyone's objectives are and whether or not there's a personal alignment and whether we'll have fun working together and what the culture of the company is like. And when we think about culture, we want to work with companies that view things through a win-win lens, not just with respect to win-win in their relationship with us, but win-win for the people at that company. So if it's a manufacturing company with 180 employees, we'd like to walk the shop floor and we get a sense for how people are treated, whether they're engaged in their work, whether they're viewed as a valuable part of the team, and whether there's career progression opportunity for them, which we think is one of the things that comes along with partnering with a private equity firm, is it opens up a path to growth that should benefit everybody on the bus. Not just 1 or 2 folks, and certainly not just the investor. And when we get a sense for the culture, that's where we really start to dial in on whether or not there's going to be a good fit post-close.
That leads me to my next question. You covered a little of it. What are the most important factors that you look for, and what does the ideal company that you invest in look like?
Yeah, so there's overlap with the last question there for sure. Certainly, we start with high-level characteristics, right? So I mentioned those 4 industry verticals that we focus on. Mentioned size, mentioned consistency of historical performance is important. We're not distressed investors, and we don't invest in startups. So that's one way for us to be a little more thoughtful with respect to our time and filter out things where we're just not going to be a good fit. Beyond that, where we dig a layer deeper, the most important things are just back on people, culture, transparency. Transparency is really important to us internally. We want that in our relationship. We pledge to be transparent with our partners. And so we also expect that in return. And if during the transaction process, we get the sense that somebody's not being transparent with us, that the information has been filtered somehow, or not getting the whole story, it sort of gives us maybe a lens into what the future would look like post-close. And that's not a great fit. Similarly, on culture, if we walk into a company and we get the sense that people are not valued there, they're just viewed for their utility towards an objective for the company, or a company, the way they speak about their suppliers or their customers is one where they're really not thinking about it through a win-win lens with everyone in their ecosystem, that's also an indication that that's probably not a good fit for us. Conversely, when we walk into a company and we can see there's a high energy level, people are engaged, people are treated with respect, people are provided upward mobility in their career and valued for their contribution that's made the company successful. And I mentioned earlier, we don't invest in distressed situations or turnarounds. So every company that we invest in, by definition, has been successful. And that's because of the people who are involved. Those are the areas where we get really excited that this is one, it's an organization we want to be a part of. Two, we'll have a lot of fun working with those people because they're like-minded. And post-close, we can accomplish big things. And ultimately, we don't come into a company trying to fix what's not broken. We're not coming in to try to change the culture. We want to back companies that have good cultures and maybe need additional resources and capital to help them scale to the next level. So that's really what we're focused on. But if the people and the culture aren't right, it's just not going to be a good fit.
It's interesting how you also covered trust. And I think that's a real foundational decision that needs to be in play at that point. And it's a marriage. There's no question to it. What do you see as the biggest assets that a private equity firm can bring to a business? And what are the benefits of a company partnering with a private equity firm?
Maybe the most obvious one is capital, right? But that's certainly not the biggest asset. I think ultimately it takes a lot of work on both sides to create a good partnership. And that means from the founder's perspective or the CEO's looking for a growth equity partner's perspective, you got to invest the time to get to know the people at the firm, understand who from that private equity firm is going to represent their investment on your board, who are you going to be working with. When things aren't going well, who's going to be that phone call that you're going to for guidance or for additional resources. And when you get to know those people, you learn a lot. And so ultimately, I think that's the answer to the question is beyond the capital, it's who are the people, what are the resources they're going to bring to bear, what's it going to be like when things aren't working well, and what are some examples where that private equity firm has been value add? Because as you know, Cliff, it runs the spectrum. Some firms just operate kind of more like a bank might, where they've got a set of reporting requirements, very hands-off, just send me this information. Other firms are very actively involved and may even take roles on a management team. We're not on either kind of extreme end of the spectrum. We like to stay in the middle where I mentioned we're investing in successful companies. The first thing is we don't want to get in the way of what's made the company successful. So we're not there to impose an onerous set of reporting requirements that consumes everyone's mind share and distracts from growing the business. We also aren't the guys to step into a day-to-day leadership role, but we do have a shared services offering at the firm. And that really focuses on things like helping with recruiting. So the companies that we invest in the lower middle market oftentimes might be a founder majority recap where there's a lean management team that might have new positions that need to be added to help them scale. And recruiting takes a lot of time. So we can help kind of run first line of defense, bringing recruiters from our network or doing the proactive research, the initial screening of candidates so that by the time the CEO gets involved, they're meeting only the highest quality, sort of 3 to 4 finalists and can assess based on culture. Recruiting's one. Certainly financial reporting. So we have someone on our team who can come in post-close who comes from a public accounting background, who can help companies, whether it's software, people, processes, scale, finance and accounting infrastructure, and also establish a key performance indicator dashboard that'll help those companies extract good information from the business and help just make better decisions in terms of how to scale. We oftentimes are helping companies for the first time construct a real 3-year strategic plan and all the various pillars that go alongside of that, and then figure out how to divide and conquer among the team as to who's going to execute on which of those. And maybe the last one I'll mention is on the marketing side. So we have a director of marketing and public relations at our firm who does work on behalf of Montage Partners, but also spends about 50% of her time with companies that we're investors in, helping those companies stand up pull-based marketing initiatives and map out a sustainable roadmap that they can carry forward to help grow revenue.
You bring a lot of advantages to those companies you invested in. Very impressive. Tell me more about the dashboard that you're creating with the KPIs at this point. Do you find the companies are embracing it and understand the strength that it brings forth?
I think it's situation specific. So I'd be reluctant to broad brush it. Some of the companies we're investors in already have their KPI dashboard pre-closed. We're not the ones to come in and say, we know better, you should change that. So if it's working and if it's productive for that team, then that's fantastic. One thing checked off the list. In a lot of cases, though, companies don't have one. That's where we can bring examples that have worked well at other companies in the past and say, okay, well, these are the things that this company was focused on. Or we can do it through more of an iterative Q&A process where we will ask a series of questions of, well, what information would you want to know? If you're away from the company, what's one piece of data that you'd want sent to you on a regular basis? Figure out what's really important in terms of executing on the growth objective. And then we can bring a set of best practices. We can also facilitate cross collaboration. So we, from time to time, I just did one of these 2 days ago, we'll host roundtable discussions among the CEOs of companies in our portfolio, where it's a confidential setting. These are companies that are not competitive with one another, so there's nothing to be concerned about. But through a relatively intimate discussion with a variety of CEOs, some of whom might be navigating challenges that are similar to what you're navigating in your business, you come away with some takeaways where you might be able to apply that to your company. And the same thing applies with KPIs. The more you hear what other folks are using, how it's helpful in them scaling their companies, the more it just might plant a seed in your mind to say, oh yeah, that's true. Maybe we should be focused on that. But again, that's not always the case, because if a company already has a recipe that's working, if they've got a KPIs dashboard, then maybe our role might be helping automate that through investments in software. But when it's a blank slate, it tends to be kind of a more collaborative process that's fun as well.
I think you bring a lot of leadership to the companies you're investing in. You're getting into the forensic, the financial analysis. You're looking at the humanistic side of it. Very impressive. How many investments do you make a year, roughly?
So we're targeting 3 to 4. So out of that 1,300 at the top end of the funnel, we're trying to make decisions fairly quickly on a large swath of those so that we can be efficient with our time. But then once you take that a layer deeper, we're really digging in on an annual basis. It might be on the order of 300 at any given point in time. And today is no different. There are 20 to 25 companies in the active dialogue pipeline. It's also based, especially at the lower middle market, where you have 2 core situations that we're investing in. One is a founder liquidity event, either a full sale or a majority recap alongside of a private equity partner, or a situation where we're backing a leadership team with the majority of the equity to buy their business from a larger corporate parent. In either of those cases, the timelines start to diverge, right? So what we say is, we're never going to be the bottleneck to close. If somebody's organized and ready to move forward quickly, our team's never going to hold up that process. But in a lot of situations, it's a more organic process of building a relationship, getting to know one another, learning how the transaction will go before making any commitments from the founder's side. Once we get into the actual kind of final diligence and documentation, things move pretty quickly. But we've had situations that if there's an advisor involved and everything's very organized, maybe it's 60 to 90 days and it's closed.
Quick.
We've also had situations where we've met an operator 18, 24 months in advance, and we just keep an open dialogue. There's no pressure on our side. This is what we do every day. And somebody just wants to sort of get to know us, and we get to know the company. It simplifies the diligence process. Everyone understands what each other is trying to accomplish. And then when they're ready, the transaction process is often pretty smooth at that point.
Very, very good. Are you using some sort of like deal room or for the data sets, through the due diligence process?
There's a lot out there. I mean, Intralinks. So yes, sometimes there are electronic data rooms. Sometimes it's as simple as establishing a Dropbox folder if it's just a direct discussion with a company. So it really depends on whether it's a broader sell side process with a banker involved, and that management team is inundated with sharing information with a large volume of folks at the same time and doing formal management presentations. In those cases, there's almost always an electronic data room.
Very good.
In other cases where if it's a just kind of direct relationship with a CEO or a founder, that information exchange, the diligence process doesn't have to be overly formal or overly formulaic. We've got our request list, and we'll try to sequence that so that initially we're asking for a limited amount of information. That's not a tall mountain to climb to organize, but it gives us enough on the business to credibly put forth a letter of intent that we can stand behind, because there aren't going to be any surprises later. We know the business well enough. We can put forth an LOI that we're going to stand behind. That's something we take very seriously. We're not the folks out there doing kind of the spray and pray approach where we're submitting bids and then digging into diligence and then getting to know the business and then changing things. We don't do that. So we invest the time up front. So that initial list gives us enough to stand behind what we're putting forward. And then later there's the confirmatory diligence list, but we sort of work collaboratively with whoever's involved at the company in providing that information to make it as painless as possible.
I think it's important. I mean, they are trying to run their company at that point, and you're adding a layer of sophistication that needs to take place, the due diligence process. Organized organizations.
60 to 90 days has the information organized. They have some good advice. They've got an organized M&A attorney, and they're ready to go in the sequence of that process. And then on the longer end, it can be just more collaborative over time, where we're gathering information, making sure that everyone's objectives are being achieved. And then we can process documentation at the end.
Very good. What do you see as the trends shaping private equity today? And what do you see the landscape looking like going forward?
Yeah, so there's a lot there. Maybe two things I would hone in on are there are more firms out there than there used to be, and they kind of come in different shapes and sizes. So it's dangerous, I think, to broad brush and just say, there's 3,000 or 4,000 private equity firms in the US, because they all have different models and sort of different focuses and different cultures, and would be different sorts of partners post-close, but there's more of them. So one trend is increasing competition. I think from the founder's perspective, that's a blessing and a curse. So on the positive side, there's more options out there for liquidity, regardless of the size of your company. There's generally more options out there for liquidity than there were 10 or 20 years ago. So that's good. And that's one of the factors that has contributed to valuations coming up over the last 2-3 years. That's positive. I think the curse side of it, or the part that takes some work to unpack, is that there's a lot of options out there and not all of them are the same. And so it takes time on the seller's side to really understand the differences between those firms, how they work, how partnering with one firm would be different than partnering with another firm. That time is very well spent. And one thing I'd wrap in here as a bit of advice is don't be afraid to ask firms for references. So do some reverse due diligence, ask for references of other founders who have sold stakes in their companies to that firm, ask for references from management teams that are currently partnered with that firm, figure out what it's like to work with this particular group when things are going well, when things are not going well, and really what are the objectives and who are the people that you're working with. So I'd say in terms of trends, there's a lot more competition from our perspective. There's more competition. It takes different shapes. That's good for the founder and also could be a curse for the founder. And they just need to put the work in to make sure they get a good outcome there. Within that growth and competition, there's more search funds out there. These are folks that are maybe freshly minted MBAs that are looking to buy a company and step in and run it full time as the CEO. And then there are this universe of so-called independent sponsors. These are folks that are out negotiating transactions, and then they'll look for capital from a variety of different sources once they've executed an LOI. And that's actually one avenue of growth for us. As I mentioned earlier, over the last 17 years, the two core themes for us are partnering with founders through founder liquidity event, founder majority recap, or backing management teams through management buyout structure to buy their business from a larger corporate parent. A third avenue of growth for us is that we are increasingly having discussions with independent sponsors and search fund-like folks to provide them with the equity that they need when they found a business and want to step in and run it. So that's both a source of competition for us as well as a potential opportunity for us, because if we can partner with a high quality person who's found an opportunity they want to step in and devote their life to and grow that company, and they've built a relationship with a founder or whoever the seller is, and it's a win-win for everybody involved, and they just need somebody to wire the equity at close and bring our shared services resources to help them, not to tell them how to do it, but to help them where needed. That's something that we've done in recent years and something we'd love to do more of. So I'll stop there. There's a lot of other trends, but those are certainly some
very insightful. I appreciate you sharing that. And it gives a nice footprint of what we're looking at, the referrals, outside individuals that are actually experts in sourcing. And then you've got that back end that actually supports the company very, very well. So it's got that added value. And I think another deliverable you shared was the companies need to do their own due diligence on who they're going to partner with on the private equity, which I think is sound advice. Please share with our listeners about the Young Presidents Organization, usually called YPO, and the value you're gaining as being a member.
Yeah, so some basic facts. YPO was founded in the mid-50s, the 1950s. There are something like 55,000 members. I think that's right, globally. It's a global organization. And it's chairman, presidents, CEOs of companies that meet certain size criteria around the world. And then it's broken down into local chapters. And it's a leadership organization. Each chapter has a little bit of a different form. For our chapter here in Arizona, I would say it's very family inclusive and very beneficial from a personal development perspective as well. It's not built to be a networking organization. I'd say that first and foremost. Where I've gotten a lot of value personally is on the personal development side and relationships that I've built and how I've grown as a leader and I think become a better person even outside of work. And I attribute a lot of that to YPO. I think it's been life-changing.
So the educational programs are structured.
So there are a lot of educational programs. There are industry-specific educational programs. There are general leadership-focused educational programs. There are so many different sets of resources and educational opportunities within YPO that you can't do all of them. It would be impossible, but they're there at your fingertips. And whether they're international in scope or for your local chapter, you can sort of self-select into what's most interesting to you. So that could be something related to a personal hobby. It could be leadership related, or it could be something that's very specific to your industry, for example.
Thank you for sharing that. Not all our listeners knew what YPO is. That was very, very helpful to understand the value proposition of joining it. What will be your legacy and what are you most proud of in your career?
So one thing I'll say that I'm proud of recently is in 2021, Montage Partners was named to Inc. magazine's list of founder-friendly private equity firms. Okay. So that for us was hugely validating, specifically because of our strategy of being a people-first firm and focusing on that founder segment, being a good partner, being a good source of liquidity, but also a good partner to the company post-close. And I think says a lot about our focus on transparency. I would say is top of mind because it's recent, and we're very proud of that because it validates a lot of what we've focused on over the last 17 years. Ultimately, I genuinely believe this, what I'm most proud of we haven't accomplished yet. Because like I mentioned earlier, we still view ourselves, in spite of having this 17-year track record, as being in the early innings of building something significant. So I think what we're most proud of is still to come. And I think ultimately that legacy ties in there that we're building something at Montage Partners and at each of the companies that we're partnered with that's bigger than myself or any of us individually, and will outlast us as well. So we'll outlast our investment. And then we'll also outlast my lifespan. I mean, I plan to do this for many, many decades to come. I love what I do and ultimately expect the firm to survive and thrive well beyond my time on earth. So I think that ultimately will be my legacy. And meanwhile, because of our values and what we really focus on, both at Montage Partners and the companies we invest in, these win-win partnerships, we really do believe that free market capitalism has done more in the last 200 years to solve the world's biggest challenges, pull people out of poverty, give people purpose in their life, provide growth opportunities, allow people to provide for their families, change their family's economic future for generations to come, than any political structure in the history of the world. And so, in spite of its imperfections, we view ourselves as having an impact within our firm and within the companies that we're investors in by treating people well, treating people with dignity, growing companies that provide career opportunities, treating customers well, treating suppliers well, caring about the environment and being good stewards of the communities that those companies invest in. And that scales on a massive level. And there are lots of other folks out there that are like-minded, doing things like what we're doing. And when you multiply that across many thousands of companies with that type of mindset, that really does have a massive impact on the world. So I think that's part of that legacy as well.
Thank you for sharing that. I think that's an extremely important message. You know, we have multiple stakeholders in our companies, and the idea of being able to look at the 360 and the touch points and really embrace what I consider to be best practices, which is that inclusiveness. At the end of the day, we really are putting people to work with families. We're helping pay mortgages. We're making an economy strong and thrive. And it's not an accident. It's planned execution, and capitalism works extremely well to do that. Is there anything I have not touched on that you would like to add, or anything that you would like to reinforce?
I would just stress to those out there that are seeking liquidity or looking for a capital partner, do your homework. Don't assume that sort of one shape fits all and that everybody's the same. I mean, there's generally, whether it's in the press or in just conversation in everyday life, there's this term private equity used, but it's just a bunch of individual firms, all of whom are different. So meet different people, get to know the people behind the firm. Every firm has a culture, just like your company has a culture. Get to know what it is and do some reverse due diligence, do those reference calls. You'll be thankful that you did. And I think if you're looking for that life-changing liquidity event, obviously put in due time. You've built a business, and take it very seriously. And I think you'll find the best people out there.
Jordan, thanks so much for being here with us today. You provided some valuable insights into private equity and the benefits of a personal, collaborative approach to it. I appreciate you sharing your story and your strategies with us. I'll share your company's web address, montagepartners.com, which is spelled montagepartners.com. Again, that's montagepartners.com. Jordan, would you like to share your contact information with our listeners?
Sure. Yeah, if you want to email me directly, my email address is jtate@montagepartners.com. Tate is spelled Tate. So feel free to reach out. And Cliff, thanks for having me on.
Thank you to our listeners. I look forward to being back with you shortly for another episode of the Private Equity Profits Podcast. This show has been produced by Market Domination, LLC.